Welcome everyone here on Twitter Spaces finally. So as you can all see, this is pretty much the first time Adam and I are co-hosting a room here, besides the test we did yesterday, which actually went quite well. And we are usually more active on Clubhouse as part of the Tesla Universe Club that everybody's welcome to join who isn't already a member. You can easily find us over there if you look for Tesla Universe and join the club. So our guest today is no other than Gary Black. And I assume most of, probably all of you know him and follow him on Twitter. And Gary will be talking about whether 2022 could be a 2020 deja vu for Tesla. And while he's talking, at the end, if we have some time left, time is a bit limited, especially given our delay that we have. We will take a few audience questions, but for now, please do not raise your hands until we get to that segment. So I will let you know once we get there. So Gary, I don't think you need to be introduced, but as they're all here to listen to you, I better stop talking now and hand it over before everybody runs away.
I'll put my New York hat back on and try to talk fast. But again, thanks everybody. I'm sorry we had those technical difficulties, but hopefully that won't happen again. So as Jessica said, I view Tesla very similar to what we saw, I'd say mid to late 2019, when there was a lot of skepticism, obviously in early 2019. And then, as most of you remember, third quarter earnings was very positively received. And then the street started taking up estimates pretty dramatically. And then, of course, China opened, the Model Y was launched, and 2020 was up 743%. And I'm not saying it's going to be the same next year, but we do have a very similar setup. And let me just go through what that setup is. Just like early 2020 with China opening, we're doubling the capacity, which is what we did. And look, when Tesla has back orders and people can't get their cars for 6 months when they order them, I take the view it's not because of a chip shortage. There's too much demand right now. And I know that's a debate. But once we can get Austin up and running, once Berlin gets up and running, and both of those, I feel pretty confident going to happen in the fourth quarter. You're not going to get all that capacity at once, but even if we get half the capacity, it'll allow estimates to go up pretty sharply. So that's point one. Point two is you got a expansion in the TAM, the total addressable market. This is what happened in early 20. Remember, the bears kept saying the Model Y was just a big Model 3. And it turned out to be, it basically launched Tesla into a whole new category called CUVs. CUVs in the US are about 40%, China and Europe about 45%. So you literally doubled Tesla's TAM. And that same thing is going to happen. It's not going to be quite as big, but once Tesla gets the Cybertruck out, you're basically increasing your TAM by about 20%. And if we do see we'll call it a sub $25,000 car, some people call it the Model A, some people call it Model 2, whatever it is, that'll expand the TAM by another 20%. So all that's happening next year. And then on top of that, we've got an investment grade credit likely by the end of the year. We've got an EV credit, 7,500 or 10,000 credit coming probably in September, which will put price parity with everybody else. In Europe, we've got the Model Y launching, which again throws you into the CUV category, which Tesla's never had before. You've got 4680 batteries being used starting next year instead of the 2170. That'll be another catalyst. And the bottom line is the 21 and 22 estimates, and 22 are more important, are going to rocket higher. Just looking at where the street is right now, people are looking on Wall Street for a 1168 volume number, and I got 1480. So that's at least 30% higher. I'm using a number that's pretty close to $10 in earnings. And the only reason I don't use more than that is because I just think it'll look ridiculous versus the street. The street's at about 730. And this is identical to what happened as we went from 2019 to 2020. I was way ahead of everybody on 2020, and then everybody caught up. So that's the setup. And I'm going to just go through the investment controversy real quick, and I'm going to turn it back to Jessica, and she can ask me questions. The investment controversy, and we've talked a little bit about this on Twitter the last few days, is I always try to boil it down to one thing, and sometimes it's more than one. But to me, right now, where the Bears and the Bulls separate is the Bears say, with all this new competition, and competition now taking the gloves off and launching branded EVs, meaning products that already have a brand. So Macan is Porsche's best-selling product. The F-150 has been the top-selling pickup for the last 39 years in the U.S. When you bring out an EV version of a branded product, you have an advantage versus starting a brand from scratch. And so that's something new. And look, what I go back to is we've always had a lot of competition coming. And EV share, I went back to 2017. It was about 13 and a half, 17. It was about 18 and a half and 18. 19 was about 23 and a half. Last year was 24. This year it's still 24. So I don't need it to grow, because if EV adoption grows, and just think about math, goes from 3% to 25%, which is what I'm forecasting over the next between now and 2025. So over the next 4 years, that's about 50% unit growth. Even if share stays the same, that's 50% volume growth. So I know people want to get into debates about EV share versus overall share. It's not really that important in the grand sense. It's just from a math standpoint. The way stocks go up is if people have to take estimates up, buy side estimates, sell side estimates. And at the end of the day, if Tesla can put up 50% volume growth, and I've got it at 55% between now and 2025, the stock is going to rocket, because people are going to have to take their estimates sharply higher from where they are today. And what you have then is PE compression. Right now the PE on 21 earnings is 140. On 22 earnings, on my numbers, it's about 75 times. On the streets numbers, it's 100 times. But as you go out to 25, you're down to like 20 times earnings, and there's no way Tesla's going to sell for 20 times earnings. And so that's where you get this, what we call a re-rating in terms of a PE, and that's what forces the stock price up, as everybody says, wow, it's too cheap to buy Tesla with 50% growth, and it's only trading at, again, 70, 80 times earnings. So that's the investment controversy. And let me turn it back to Jessica, because again, I know there's some questions you have, and then we can turn it over to the audience, see what questions people have.
Yeah, I don't really have a question regarding that specific topic, but what I was doing is I was looking up some old articles from like 2 years ago, from 2019, and it sounds so familiar to what we're hearing today.
Yeah.
Like if I read you that short Reuters article, it will sound very familiar to you. So that was after the Q3 earnings. And it says, while Tesla delivered, that's October 3rd, 2019. Just keep that in mind. While Tesla delivered a record 97,000 cars, it missed Wall Street estimates of 97,477 vehicles, and more importantly, fell short of 100,000 deliveries that CEO Elon Musk said the company had a shot at in an email leaked last week. And we're still talking about the exact same issues. If Tesla fails delivery numbers by a few hundred cars, all hell breaks loose, right? That hasn't changed at all.
Right. Well, one thing that is different, and so you had a lot of fuel back then because you had a lot of shorts in the stock. The short interest on Tesla was in the 15 to 20% range, and today it's like 5. So you don't have all this fuel as the shorts say, "Oh wow, I'm wrong. I better cover." But you still have a decent, as you know, a decent short community, and a lot of people who are betting against Tesla. The other thing you got different is you have active managers who have not bought 1.5% interest in Tesla, even though that's what's in their benchmark. And a lot of them just look at it and say it's expensive. And as Tesla continues to beat numbers, it looks less expensive. So I think there's a lot of fuel, but it's more going to come from managers who are underweight Tesla than it is from shorts that are going to cover. The other catalyst that's worth talking about, because there's a lot of confusion about this, is the EV credit. And maybe it's a US versus Europe thing, I'm not sure. But there's a lot of talk. Well, the Senate passed this thing that said, the EV credit can't apply to cars more than 40. That's irrelevant. That's not useful. That was one Republican trying to make a name for herself. And what is important to watch is, once they're both on vacation right now, the House and the Senate are both out until I think the week after Labor Day they come back. Then they'll start working on this $3.5 trillion infrastructure bill, and you'll hear this term reconciliation. That just means you take the bill that's already been passed. There was one bill, and then you're going to have a House bill that was in the Senate. Then you're going to have a House bill that gets passed, and you're going to reconcile them in what they call reconciliation. And the bottom line is, they haven't come up with what the EV credit is going to look like in that House bill. There's a lot of talk about it, but until you see the language, you really can't say what it's going to be. My hunch and my instinct, based on people I talk to in DC, who do follow this, and you have GM on the same side as Tesla. It'll be a $7,500 credit. It'll be $10,000 if it's American made. There may be a cap on the value of the EV, but it's not going to be 40,000. It could be 60, it could be 80, it could be a number, and then you get it phases in like a pro rata amount if it's more than that. But I think it'll go up to 80,000, and because at the end of the day, if you look at the Ford F-150 and you look at some GM Silverado and some of the other cars, you're up in the $60,000-$70,000 range. So even if it's 60 grand, think about it, the Model 3 and the Model Y will both be covered. And so at that point, you're going to have price parity in the U.S. You haven't had price parity since Tesla got through that limit. It was 200,000 cars, several years ago. So you'll be at the same price point as everybody else. And it's probably going to be a rebate where the buyer gets it at the purchase. It gets taken off the purchase price, and then they figure out the accounting afterward through the government. But that's an important point. And that'll probably happen, just so you know, it'll probably happen by September 30th, because that's when the government runs out of money and they have to get it passed before September 30th. So I think that's important. And then the other thing that I think is important is the investment grade credit rating. Right now, Tesla's a couple of levels below it. S&P, I think they're 3 levels below on Moody's. They're running out of debt, and they're generating so much cash flow. Tesla's going to generate about $4 billion of cash flow in the second half. And as of today, they redeemed this $1.8 billion issue, the 5.3% senior notes. They're down to 7.6 billion of debt, and between Bitcoin and cash, they have 17.5 billion of cash. That type of ratio, you do not see that with junk rated paper, where they have so much more cash relative to debt. Bond holders look at things like fixed charge coverage. On fixed charge coverage, so you take operating income, add back the interest expense, divided by the interest expense, it's about 18 times that. That would be investment grade. Debt to equity on a book basis is less than 30%. That would be investment grade. On a market basis, like 1%. And when you look at that free cash flow, you say, what are they going to do with all that free cash flow? They're probably going to continue to retire debt. There's very little. There's low odds that they don't get to investment grade, and I think they're going to wait till fourth quarter, so sometime in January. But why is that important? There are a lot of equity funds that can't own equities where there's junk rated paper. That's one important point. 2, the beta goes down. 3, interest expense goes down. 4, people don't have to worry more about equity offerings, because they're going to have to build more plants. UK would be where I would think would they look next. I still think India. There's a lot of debate about India, but with something like 10 million people that make at least $30,000 a year in India, no EVs sold in India. There's I saw in Statista, there's 15 million people with at least $100,000 in net worth. It's a great market for Tesla, and so I think once Elon gets, and others are asking them for reduction in import fees from 100% to say 40 to 60, they'll start selling the China-made Model 3s into India. They'll see what kind of reception they get, and then give it 6 months to a year, and they'll start building a plant in India, and that'll be another let's call it 250 to 500,000 of capacity added to Tesla. So those are all important points to watch as well.
Yeah, Gary, Adam here. Just as an information for the people in this space, if you scroll to the top of the window, you'll see we've added 2 of Gary's tweets for you. You can scroll left and right between them. One of them is the catalyst that Gary posted 4 days ago. Obviously, there's a whole host of catalysts coming up in the future, but I've also added the tweet you had on the 20th of August, Gary, talking about how the development of the estimates is yet to be seen in the price. Do you have any reflections on how powerful this is of a driver? You call it the most powerful driver, but what can we, with a basis in that, say about what's going to happen or what could happen in the future? And obviously, anything we say here is not investment advice. You should contact an authorized financial advisor, of which obviously Gary and his fund are. But I'd like your opinions on that.
Yeah, so let's just go through what estimates mean, because estimates drive stock prices. So this is sell side estimates. This is Wall Street. There's, I don't know, 40 people or so who cover Tesla, and they post their estimates. They've really come up since earnings, second quarter earnings on July 24th, I think it was. The 21 estimates are up about 20%. The 22 estimates are about 15%. But what I try to look at is the volumes, because the volumes obviously drive the earnings. Because you can take, every unit of volume, use an average selling price of about 50,000, use an average gross margin of about 20%, and just see what it does to earnings. And so I have earnings estimates for next year of 980. The street's at 730. And all of that difference can be explained by I have 1.48 million units being delivered next year. The street has 1176. Now, why is this important? Because a lot of the buy side, okay, so these are the folks at Fidelity and Capital and Jennison and other, and look, ARC is part of the buy side. Ron Barron's part of the buy side. But think of the incremental buyer of Tesla, and the markets are hitting all-time highs every day. People are looking for great growth stocks. And I'm telling you, a lot of people are still underweight Tesla just because it looks expensive on PE. There's a lot of, I'd say, skepticism still of Tesla. A lot of people look at last year and they say, well, I missed the big run, so I'm going to wait till it falls back. But as the estimates go higher, and this is the bottom line, we can all assume that the buy side estimates will also go higher, because a lot of the buy side, they don't cover one stock or 10 stocks like the sell side. They cover 50 to 100. So a lot of times they rely on the sell side for their estimates. They're not doing the detailed work that a lot of you all do, what I think I do, in trying to forecast this. They rely on buy side estimates. So when I'm sorry, sell side estimates. So when sell side estimates go up from, let's call it 730 to 980, and let's suppose the PE stayed exactly the same, you would think the stock price would go up at least 25%, the difference between 980 and 730. And so I think that's a huge guess. What we saw in 19 is once the China factory opened, that's when people took the estimates up. So I think once you see Berlin and Austin both open at the same time in the fourth quarter, you're going to see the estimates for 2022. And, at this point, we're going to be in October, jump up, and that's going to put another, that's going to put even more of a propellant to the stock, for lack of a better word.
Yeah, you've listed 8 possible catalysts, Gary.
Yeah.
But of them, how much of it is baked into your price target? Right? You have a price target of 6 to 12 months going out forward at $1,100.
Okay, so let's go through that, because
Sure.
I get a lot of flack from people. I get flack from the Tesla crew that I'm way too high, and I get a lot of flack from the bulls that I'm too low. And look, I try to be cautious. I'm by nature, try to have conservative estimates. I try to make sure that whatever I put out there, I think is really achievable. And so I have $1,100 price target. It's based on going out to 2025. I look at EV adoption, which I've got going from 3 to 25% by 2025. I'm holding EV share at 25 roughly. And so, when I do the math, I get about $32 in earnings on 2025. And that's based on 5 million of deliveries in 2025. And I do pull down the ASP because I assume Model A or Model 2, or whatever you want to call it, will pull it down. Cybertruck will push it up. And I have, gross margin basically growing a little bit. It's about 25 this year. I got to go to 26. But the bottom line is I've got $32 in earnings in 2025. And then the debate is, what multiple do you put on that? And I'm trying to be conservative. I put a 50 multiple. And again, on 21 earnings, it's 126. On next year's earnings, it's 72. Because come 2025, people will be looking forward from 2025 and say, what are the earnings growth going to be? What's the earnings growth going to be going forward? And so once you're at 25% EV adoption, I've got to go into 50% EV adoption by 2030. But if you try to figure out what that is worth in volume, it's not going to be 50%. So I've actually got earnings slowing to between 20 and 25% come 2025. So that's why I put a 50 PE on it. But even at a 50 PE times 32, that's $1,600. I use an 11.6% cost of equity. I want to get into it, but it's tied to interest rates, and it's tied to the beta. Okay, so the beta is 1.6. And I use a 2% risk-free rate, even though the 10-year right now is at 1.3-ish. But I use 2 because you're supposed to look out, over the next few years. And the beta of 1.6 is going to come down, especially if they get to investment grade. So I'm assuming 11.6% cost of equity, and that gets me to about $1,100. Now, where there's controversy is FSD. And I try to take the view, again, trying to be conservative, but I really do believe this, that, we're at level 2 using vision only. It's a great product. I've been in. I have a Tesla Performance. I'm not a beta tester, but I've been in beta tester because I think it's wonderful and it'll sell a lot of Teslas. I guess where I think I differ from some people is I believe that come 24, 25, all high-end vehicles are going to have some level of FSD. And while Tesla has a huge advantage over other people, particularly, when you think about how to scale it up, because you just push the button and my, Model Y Performance, once I push the button, will be activated. And that's not true of other people. I do think you're going to see a lot of competitors have some form of FSD. It might be level 2, it might be level 3. But at that point, I think it's going to be very hard to say, Tesla deserves a separate incremental value for robotaxi because there are going to be a lot of players that have the same level of FSD capability as Tesla. And I know that's a debate. So I try to view it as, in my model, I assume a certain take rate of FSD. Right now, it's only 11%, which, again, we can come back to this debate if we want. It's about 18 in the US, it's 16 in Europe, it's like 1 in China, okay? But it's overall, it's 11. And the other thing you can look at is the difference in residual value. You can look at a used Tesla, Model Y, Model 3, Model X, and line up the options and then compare them. You see that an FSD add-on is worth about $2,700. Okay, you can look at it your own way. You can look at a whole bunch of Kelly Blue Book and others, but you'll see that the difference with FSD versus without is not that high. It's not $10,000. Now, what a lot of people say to me is, well, that's because it's not level 4 yet, and they're probably right. But I still think people are overvaluing FSD in their price targets. So what I do is I take a take rate, I multiply it times 10,000. I don't think the $199 a month is going to take off. It hasn't so far. And that's how I build my revenue model up. That's how I get to my $32. And I deliberately add no value for robotaxi, even though there could be some. Okay.
So what you're saying, regardless if one agrees or disagrees with this perspective on FSD, essentially your model would come as an upside to that, if I understand you correctly.
Sure.
Yeah.
It's icing on the cake. It's a
potential upside.
It's icing on the cake if we get it. So even without any value for robotaxi, I see $1,100. And if there does happen to be a robotaxi, network out there with a Tesla brand on it, and either Tesla sponsors it or it makes its way into Uber or Lyft or Diddy or anything else, that's all upside. But I'm trying to be conservative.
All right. If I may just jump over to the infrastructure bill, Gary, for a moment, the $3.5 trillion there. Have you had any rumors as to whether or not there'll be a limit to that? Do you have any ideas of what that would be, and if so, roughly how much?
When you mean a limit, you mean a limit on the bill or a limit on the?
No, on the vehicles.
Well, like I said, I've heard that a lot of people are saying 80,000 seems to come up a lot. Like if it's more than 80,000, you'll not get it. A lot of people say 60. It's not going to be 40. I mean, the average car in America is 40, and Ford and GM are not going to allow it to be 40. So they're going to drive this bill because they have 12 people sitting in government relations each, and they talk to the Democrats again who are going to sponsor this bill. There's going to be something. I think it's going to be $7,500. It'll be $10,000 if it's made in America. You're not going to see something that says, well, if it's union made, maybe it's $12,000. You've never in the history of the tax code ever seen a tax benefit based on whether it's union made. What they will probably have to show is that there are fair labor practices, that if Tesla wants to unionize, they can. They have the ability. But there's never been one where you have an additional tax credit for something that's union made versus not union made. So I don't know whether it'll be 60, 80. There might be something. I would bet it's going to be 80 is my bet. And I guess the other debate is, will there be a cap on the number of units,
yes,
as there was this time? I don't think so, because I think GM and Ford and the others all think 100% of vehicles by, let's say, 2040 are going to be EVs. So I don't think they're going to want to put a cap on it.
That's interesting. I was just in terms of if we just move it just to the investment grade. So we've been looking at Tesla's investment grade, and I know a lot of people in the markets were suggesting and maybe hoping for an update there in January. Why is it that we just don't get an investment upgrade now? I mean, it just the net cash seems to gradually improve as we go from quarter to quarter.
Because S&P and Moody's are slow, and I having dealt with them both, as a CEO of a company that had debt, I ran Janus and we had debt. They're just slow. They use book values instead of market values. They don't look at cash flow. They're very accounting driven. They're extremely slow. Look how long it took for Tesla to get into the S&P 500. It's a very I can't even describe it as bureaucratic. They're just very, very slow moving. And so because Tesla's had so much controversy, and because, go back to 2018 and 19, there was a lot of talk. They might not be able to pay their debts. I think they're going to give it another couple quarters. I think they want to see what happens third quarter, because third quarter, that's when the volume is going to be much higher than second quarter, and then fourth quarter is going to be a blowout quarter. So like 220K volume in the third quarter, 250 in the fourth quarter. I think if you get to the fourth quarter, and the free cash flow is huge by the time you get to fourth quarter. I have about, let me tell you what I have. I have in the third quarter free cash flow of about $1.9 billion. It was $600 million, by the way, in second quarter. I have $1.9 billion third quarter. I've got $2.4 billion in the fourth quarter. And I think they're going to wait till they see another couple quarters of huge volume growth, of huge free cash flow generation, and then literally Tesla runs out of debt. There's just not enough debt left. There's only $7.6 billion of debt today. So there won't be any debt left. So that's why I don't. It should be investment grade. The bonds are priced as if it's investment grade, but I still think you got another couple. What you might see between now and then is a couple more upgrades. Again, you got 2 levels between where it is today on S&P and investment grade. You got 3 levels on Moody's. So you could see interim upgrades, but usually they do it like around quarters. Like you get a quarterly result and then you see an upgrade. So we haven't seen it. I'm surprised we haven't seen it in the second quarter, but I bet we'll get some after third quarter, and then you'll see full investment grade status come, after fourth quarter, which will be end of January.
Yeah.
So Gary, I actually just shared a tweet from JPR 007.
Hello?
We got that you shared a tweet from JPR 007, Jess, but then you
If you look at,
can you tell me what it says?
Adam?
You
should see you see it here. I shared it in Spaces. It's a tweet by JPR 007.
Yes.
Yeah, I know him. 007, Mr. Bond.
Yeah. 007.
Yes.
So as you can see, like Tesla has almost zero debt compared to all the other OEMs, and yet they have this very bad rating. Like what's your view on this?
It shouldn't be.
If you look at this,
I can't see it. I'm sorry, I can't see it on my phone.
Can you see that?
Yeah, we can see it. If you just scroll up within the space, Gary, you'll see one of your tweets maybe, and then you can swipe left, right on the dots.
Okay, I just don't want to screw this up again.
That's okay. Essentially, Jessica is just showing us that Tesla, compared to the other OEMs, have literally no proportional debt, whereas the others have anywhere from 30 to 50%, 60% debt, it seems like.
Like I said, I think, look, the Moody's and S&P both look in the rearview mirror a lot. Where, as an analyst, I'm very comfortable going out because I follow growth stocks, 2 years, 3 years, 5 years. That is not how these guys operate. They look backward and they don't anticipate anything. They don't try to forecast. And so from a, free cash flow standpoint relative to debt, from a what I call fixed charge coverage, which is you can use EBITDA divided by interest expense. You can use operating income plus interest expense divided by interest expense. Some people use fixed charge is where they include rents. There's no way Tesla should be anything less than investment grade. I think it's all based on the history that this was a company that has come really far, really fast. And I think what they want to make sure is this thing is sustainable. Who knows? Maybe they believe that, competition's all coming. And look, we can talk about that more because to me, that's the most interesting controversy about Tesla. And competition, just so you know, there's about $30 billion of ad spending. So that's TV, radio, newspaper, digital, $30 billion by the industry. And, they're going to shift 80 to 100% of their ad budget to EVs because they all believe correctly that the world's going to go 100% EV by 2040. So maybe that's what they're waiting to see is with all this new competition, can Tesla actually continue to grow? And maybe that's what they're waiting to see. But I agree with everything JPR says.
Yeah.
Mr. Bond.
Well, I would love for them to be wrong, because if they have that mindset, I think a lot of us that are investors will benefit from the surprise when the Tesla continues to grow.
We'll see it. We'll see it. And we can all be patient. We saw it in 2019.
Yeah.
I was surprised at how inefficient the market was at figuring this out. I was surprised. And look, I talked to a lot of the shorts and, some of the very famous shorts without mentioning names that have been in the stock. I would get on the phone with them or, email them back and forth. And I was just shocked that they couldn't figure this out, that you all did and I did, that earnings were going to explode in 2021. And I think the bottom line where they missed it was they thought that the Model Y was just a big three. And they missed that when you go into a new category, and this is TAM and this is brand leverage, when you go into a new category, like CUVs, which are 40% of the market, and currently you're 20% market, you're tripling your TAM. And so they just missed that. And when you go into China, or you go into, this is a great one, Model Y is now going into the EU, and they'll start making it in Berlin in a few, let's say months. But you're basically doubling your TAM in Europe. And I don't understand why people who are very smart, they just don't get it. So but that's I think the problem with the rating agencies. They can't really look forward like that. They don't think in marketing space, they think in accounting space, for lack of a better word. Hey, can we just spend a minute before we turn open just talking about some of the competitors, because I know there's been some debate
Sure.
about Nikola, Ride, Rivian.
Yeah, I'd love your opinion on the Rivian stuff, Gary, if I may. I know it's a bit off topic here, but I know a lot of people would love to hear your reflections on that.
So Nikola and Ride are both they're pretenders. Ride has the endurance. They've just got another CEO in who's a Carl Icahn guy. They'll probably put the company up for sale. It's not worth anything. They're never going to get the endurance up and running. They're supposed to start production soon, and they say they're going to start delivering next year. But it's going to be after Rivian. It's going to be after Cybertruck. Nobody's going to buy an endurance for 60 grand when they can buy a Cybertruck for less and buy a Rivian a little bit more. Nikola is a total pretender, and Jessica, you've been involved with Trevor even more than I have. But the stock's worth $2. That's the amount of cash they have on their balance sheet. And at some point, everybody's going to wake up and say, "There's nothing here." They're not going to ever deliver one truck to Anheuser-Busch, which is their one remaining customer. And I don't know why people don't see that today. The stock is $10. It really should be worth $2. Okay, enter Rivian. Rivian is a real deal. These are, it's very high quality from what I could tell. They've already got production up and running. They're now looking for, and it's in Illinois. It's about 2 hours south of where I am today in Chicago. They're looking for a second site in Fort Worth. So I think they're going to divide it, west U.S. and east U.S. They're focusing on the most profitable part of the market, which is pickup trucks. And so they're going to launch the R1T. We'll say this year, because they're starting to produce it already in August. They'll start deliveries by the end of the year. And then the R1S is the SUV. Those are the two most profitable models that you could produce. That's where all the margin is at Ford and GM. And so I just did some simple math and said, okay, the U.S. market, let's forget about the rest of the world. The U.S. market has a 17 million SAR, which is a seasonally adjusted annual selling rate, SAAR. Pickups are about 20% of that. So let's just call that 3 million. If they can even capture 5% of the pickup market with Rivian, and Rivian has some really cool product benefits, and you've seen all the pictures, in addition to doing the tank turn, which, people who own trucks, this is what they do. They go, they go in the back, and this is what they do. They go onto trails and, they all hang out and they do things like this. This is what, they like to do. But you can do things like you got this little camp, kitchen that comes out of it for $5,000. You got a tent you could put on top of it. It's got a motor for each wheel. So if I take 5% of 3 million, that's 150,000 vehicles, and that might be a lot. The capacity of the plant they have in Normal, Illinois, it's an old Mitsubishi plant, is 250,000 vehicles a year. So they can easily make 150,000. You multiply it times 75 grand, which is a lot. Okay, that's what they're trying to get. The base price is 67.5 with 300-mile range. I think the 400-mile range is $10,000 more than that. They get 75 grand, and it can get to 20% margin. That's a big if, because it may take them a couple of years. you're talking about $1 billion in net income, even using a 20% tax rate, which they may not have any taxes. You could easily put an 80 multiple on that because that's what Tesla's multiple is going to be. So look, I'm not going to buy it in my fund, but I can definitely get an $80 billion valuation. And they got Goldman, Morgan Stanley, and JP, which are the three big bankers that are basically going to do this deal in November. And they've been very precise. They know that they got to get the production up and running first. They're going to get some good reviews in Motor Trend and Road and Track and others, and then they'll do the IPO in November. I wouldn't be surprised if this thing goes off at 80 billion. Again, I won't buy it at that, but I do think they can probably get it off at that.
Yeah, it definitely is a alluring concept, but NEO is roughly $60 billion. XPeng, I think it's 36. When Tesla IPO'd, it was less than $2 billion. And when Tesla was 80, they were still producing thousands and thousands of cars, right?
Right, but Tesla paved the way. Okay,
Yeah.
so you think about ETFs. ARK paved the way, so anybody who comes in now has a head start from where. Same thing with Tesla. Tesla paved the way for these guys, and back when Tesla did its IPO, you didn't have EV adoption. Everybody agrees it's going up pretty dramatically, and now, and you just think about IPO. You look forward, people will look at it and say 2022 EV adoption will be 5%. And they have a superior product to the Ford F-150, GM Silverado. So the products out there just they're not going to be as good as Rivian. So I just think people are going to put a high value on it.
Okay. I've registered that you've started a fund, Gary, or an ETF. So we have some tough questions for you here. Why did you start an ETF and not a fund? What's the benefit of an ETF as opposed to a fund or a mutual fund?
Well, there's no comparison. The tax benefits of an ETF are huge over a fund. You buy a mutual fund, and you decide you want to put money into a mutual fund. You inherit the tax gains, tax losses. But we've had a bull market now for many years. You're going to inherit taxable gains. With an ETF, the what you pay for the ETF is your tax basis. And I know Ross has talked a lot about this, and Ross and I are pretty close. And he's right. When you don't have to pay taxes within the fund, you can reinvest 100% of, if you want to sell something. But when you have that tax status that is based on what you pay for the ETF, and if you keep that ETF for at least a year, you have a long-term capital gain. That's a hell of a lot better, value proposition from a tax standpoint than a mutual fund where you're just going to get allocated whatever the taxes are within the fund. And that's a huge benefit. The second huge benefit is just transparency. Mutual funds publish their holdings once a quarter. Sometimes they'll put them on the website once a month. ETFs every night. And to me, it's very funny watching a lot of the competitors out there, T. Rowe, Fidelity. They want to do what they call non-transparent, transparent ETFs, which kind of it's a conundrum to me. It kind of defeats the purpose of having an ETF. They don't want to show their cards. That's why you haven't seen that many, because they're all afraid they're going to get front run. And as Kathy Wood at ARK has said, look, I don't care if people front run me. I take it as a good thing if everybody wants to buy the same stocks I own. And so I take that same view. I think transparency is what people want. That's the future. And so having an ETF, it's transparent. We are going to do the same thing that ARK does. We're working on it right now. Probably take us a couple of weeks. So if people send us an email, and we'll have a little button on our website, we will send them every night what the changes in the portfolio, so you can see them every single night. But the ETF is tradable every day. It's much more liquid because you can get in and out all times a day, where a mutual fund is once a day. It's portable for a broker. They can bring it, with their accounts wherever they go. It's like bringing a stock, and it is trading stock. So our ETF, without, I don't want to give you too much of an advertisement, it's ticker FFND. It's traded on the New York Exchange. We had a really good, by luck or by skill, we had a really good start. The first week we're up about 2.1%. I think the S&P is up about 1%. Russell 3G, which is our relevant benchmark, so that's Russell 3000 growth, is up about 1.5%. And we've had some good wins so far, so I feel pretty good about that. And what I think is different. People say, "Well, how's you different from ARK?" And again, a lot of respect for Kathy Wood. I used to work with her in Alliance. I think what we do different is, we're looking at mega trends. And we have 10 mega trends that we're trying to find companies that capitalize on them. And you've seen them, but it's 24/7 information entertainment, it's social network, it's mobility, it's e-commerce, it's fintech, it's people living longer, it's automation, it's climate sustainability, which is Tesla. And we try to find companies that can capitalize on those megatrends. When I think of a megatrend, it's a tailwind. It's a tailwind that helps with the volume growth. So again, with EV adoption, it's growing from 3 to 25 over the next 5 years. That's 50% volume growth, even if you just hold your share. And that's kind of the big thing that's different. I think the second thing is I'm sorry, go ahead.
No, I've followed. I'll happily admit that I've occasionally followed, and I don't know if front-running, but followed your trades on Tesla myself personally. I'll happily acknowledge that. But I'm wondering, because Tesla is your biggest holding as it is, right? But I've seen a lot of the other funds, Gary. If Tesla does well, they'll sell themselves a bit down. Do you have, sort of based on your composition today, would you have room to own a relatively more share of Tesla, or if Tesla was to continue like it's done this the last week, would you be selling your Teslas?
No, I think, look, we have a 10% max, and we chose 40 as the number of positions we want. And both Dave Kalis and I, we have 50 years of experience between us. We're both very senior. We've worked together before. We both feel very comfortable with 40 stock portfolios because we don't want to have drawdowns. We don't want to have a situation where one stock is down, let's say, 15%. That's a 4% holding, or even 20%, like Zoom. Zoom today is down something like 20%. We don't want to have something that's that big that can be down that much. So, 40 stocks, we keep the positions a little bit smaller, but the ones that are highest conviction, the ones where we think we have the highest, we call it risk reward. So the highest upside versus downside. Every one of our positions has to have at least 2-to-1 upside downside on a risk adjusted basis. Those have the biggest. So with Tesla, we're at 6.3% weight. We could take it up to 10 if we had really high conviction along all the fronts we look at. We would take it to 10, but I don't see us trimming it in the meantime, because I think we're entering a period where when Tesla estimates start going up after Berlin and Austin open up, you're going to see the stock. What gives me the biggest pause about Tesla, and again, I'll just be very candid because you guys know that's the way I am about this stuff, is if we have more of these incidents where, let's suppose we have FSD out there, and let's suppose we make it available for everybody, and there's a couple accidents, and there will be. And is that going to cause Tesla to go down? You betcha. So that's kind of the risk out there with having Tesla too big. But as long as I've got these other things, and I've seen with the press, even with this accident that was last Friday, where a Tesla and Autopilot reportedly, and I'll use that word in quotes, hit a police car. It isn't really affecting the stock, surprisingly. So maybe journalists have gotten kind of wise to the idea that it's not just Teslas that run into police cars, and maybe the guy was drunk, maybe the guy was sleeping, who knows, or the girl, whoever was driving the car. But that's why we don't put it up at 10%, because we don't want to have a drawdown. We think 6.5% is plenty big. If the stock goes up, we're thinking it's going to go from 738, which is where it is today, to 1100 within 6 to 12 months. That'll be plenty for us in the future fund to deliver good returns for our shareholders.
Yeah, and the future one will then have the sort of, you'll still be within your mandate to grow up to 10%. So this, because that has been frustrating to me when I've invested in some of the ETFs. So they'll have a position in Tesla, but if it goes up, they'll just trim it down, and that's not the exposure that I'm necessarily looking for.
Right. I think, look, if a lot of you will own Tesla in your own accounts, in addition to whatever you own. If you own, ARKK, or you have, Ross's GK fund or our fund, you can supplement if you want to take it bigger. I think what is different about our fund is we try to have what we call 40 uncorrelated bets. Okay. When you look at our holdings, they are not correlated. Tesla, Snap, DocuSign, Zoetis, which is an animal health and vaccine company, Tencent, which is one of the largest internet companies in the world out of China. It's being hit because the regulatory crackdown. But it's interesting because everybody keeps saying it's not going to affect their business. PayPal, they're very differentiated positions. So we use risk metrics to try to make sure we don't have too much of any one bet, because we don't want, as let's say interest rates go down or interest rates go up, let's say, we don't want everything to be going down on the same day. And so if you look at our portfolio, like today, we're only down 7 basis points. And I look at, what ARC's doing, what GK's doing. We're having a relatively good day, even though the market is still down. So we're trying to have, good returns because they're all growth stocks. They're high conviction names. The average PE of our average company is about 52 times. So it's a really growth stock, really good growth stock. 20% revenue growth is the average. But on the other hand, if something blows up, we don't want to have a big drawdown.
Yeah, that would be a differentiating factor. Sorry, Jess, go ahead.
Yeah, I was just about to say we're already past the hour, but Gary, if you have a few more minutes,
I'm fine. I'm fine till I'm good for about 10, 15
should
minutes.
we take some questions from the audience? Or Adam, do you have more questions for Gary?
No, I think this is very insightful. When we did a trial run yesterday, it took a bit time for us to get people on stage. So
yes, it's not super fast.
It's not as fast as Clubhouse, but do you need to open something up, or can people just raise their hands?
No, people can just raise their hands, and they are already doing it.
Okay, awesome. Because Gary and I are speakers and not co-hosts, so you will have to manage that one, Jess.
Yes, I will. Give me just 1 minute. Sure. Keep talking in the meantime.
What are your thoughts about Lucid, Gary?
Lucid to me is wait and see. They're launching first with a $150,000 vehicle, and there's a limited number of people that are going to buy that. I think it's probably a great automobile. I haven't actually test drove a Lucid, so I can't tell you that how it feels and how it works. Looks nice, but at $150,000, that's got a very limited demand function. And look, they're going to use the Mercedes approach. You start at the very, I could argue the Tesla approach. You start at the high end, and then you leverage the brand down. And then by next year, they'll be apparently delivering $79,000 Lucid vehicles. So I guess I'm in a position of I'm going to wait and see. It's a much cheaper stock than it was. I do think it'll succeed, unlike Nikola and Lordstown, which I think they'll basically not even be around in 5 years. They'll be sold or they'll be bankrupt or liquidated. And I think Lucid can do fine, but I'm a little more optimistic, I think, on Rivian than I am on Lucid, just because they're going after the most profitable part of the market, which is pickup trucks and SUVs. And that's not Lucid. Lucid's sedans.
Yeah. Well,
awesome. So we have Tesla Steve.
Hey,
Tesla Steve, do you have a question?
Thanks. Hey, Gary. Thanks for all the insights so far. I'm just curious as far as like the battery technology and kind of like the rest. I know you're being very conservative with FSD and a lot of other things, which is great. But as far as like the batteries and power walls, solar, kind of all that stuff, how much you're kind of putting that into your future estimates, or that's still kind of just icing on the cake. And then just one other thing about your fund, if you would think about adding Roku, or like where your thoughts are with that.
Well, you could buy ARC and you get Roku. Look, I've heard about energy as being not a big part of our price target, and it isn't, because they just don't make a lot of money. Now, I go out 5 years, and even in 2025, I don't have a lot of profits, relative. And I'm just going to give you the 2021 numbers. Automotive is going to make $12 billion in profits. Energy will be flat, like zero profits. So you can then go out, 5 years and say, okay, because of the battery technology and Tesla's got a head start with everybody else, maybe they can do something. I just don't see, if you do the math, I just don't see a lot of incremental value with energy. And then, there's another part of this. We own, for instance, Generac. Generac, as you know, when the storm hit this weekend, you saw all the ads for Generac, people, buying $2,000 Generacs. I guess the question is, there's a competition. The competition is, solar and power walls, but there's a huge difference in price. For a generator, you need about $2,000 for, solar panels and power walls, and you need at least two. You're up above $40,000. So it's not that I'm negative on it. It's just so small relative to the automotive profits. I build it into my model, but I don't, from a mathematical standpoint, it just doesn't add that much.
Yep. Yeah, it makes sense. Yep.
Okay. Good question, though.
All right, next up, I think we have Frank. Go ahead, Frank.
Oh yeah, well, thanks, guys. Just two quick questions, I guess. What valuation would you buy into Rivian? And my second question is, what macro environment risks do you see with Tesla, over the next year or two that would affect not the company but just the stock, or all of those stocks in general? That's it.
Yeah, Rivian's tough. I want to go drive one. Again, they're producing them now. The plant is about 2 hours south of me. I want to go visit it, and they have like test drives. You can apparently they'll take you out on them. I just want to see how it actually looks, feels, behaves. People who've driven them, and there's a lot of stuff on YouTube. I mean, they're incredible. I mean, they climb up these giant rock mountains and come down, and people have said it's like nothing they've ever experienced. So, and I want to see, and this will all be before the IPO. I want to see what Motor Trend, Road Track, and they'll get their own vehicle, and they'll be able to put it through the normal test they put things through. I just think it's a good number two to Tesla, and because you're playing in the most profitable part of the market, and it's very bad news for GM and Ford, by the way, because it's where all the profits are. I just think even before they get to the SUV, something around 70 billion, I might be interested, and look, we don't know what kind of market we're going to be in come November. And this goes to your second question, the macro. Look, what happens with Tesla is interest rates move up or down, inflation moves up or down, COVID gets worse or better, and those become really important factors. And that's why, every morning I try to put out a little summary about, here's the way I see it. And I'm always wrong. But usually I'm wrong because I get the macro wrong. And so today, you've got somebody from the ECB talking about tapering there, and that drove the market down. Now, Tesla seems to be doing its own thing anyway, and in a down market, it's actually up, almost 1%. So I think if interest rates, to answer your question, Frank, if interest rates picked up a lot from the 1.3-ish where they are today, like you get to 1.7, 1.8, even though I use 2% in my price target, I think it does cast a pall over all growth stocks, especially long duration growth stocks. And the valuations just won't hold up as well because people will worry about further interest rates rises. And so right now you've got the Fed that's talked about tapering starting later this year, meaning they're going to reduce their bond buying. They buy 120 billion a month. They're going to reduce that slowly. Powell is a dove. He's got a lot of people on the Fed that are more hawkish, so he has to balance. It's a political institution. I think they'll start tapering slowly later this year, but they're not going to touch interest rates till late 2022 or early 23. So I think we're going to be fine. I think we're in a really good environment now, and a lot of it's because of COVID. When you look at the COVID cases, and yeah, I get on every day and I look at the 7-day average and the yesterday, and I look at US, I look at worldwide, and they really haven't started to fall yet. UK started to fall, but the US is still, I think it's 250 was yesterday, and like 150 is um, I think it's the 5-day average I'm looking at. And that's really a problem because you're starting to see more mask usage, which is nothing, but you are starting to see people limit when things can be open. And if it makes things close up again and it makes people stay home and makes GDP fall, that's not good for growth stocks either, just like it wasn't last year in March and April. And Tesla fell by more than the market. So I think it's going to be fine because of the vaccines. I think it's just it's a spurt. And I think just as in the UK, you've seen it come down, I think you'll see it come down in the US. And I think the macro will be fine. You're going to see, something like 6% GDP growth for this year, which is huge. Next year is really more important, 3 to 4, probably 4. And interest rates, if they stay low, growth stocks should be continue to perform. Just one more piece of math. The S&P right now trades at 21 times next year's earnings. S&P earnings next year about 220. So if you do the math, the S&P is at 45.26. It's about 21 times. That, if you flip that, the inverse of that, that's a 4.9% earnings yield, E over P ratio. Okay, so the inverse of the PE. Compare that to a 10-year Treasury of 1.3. That spread of 360 is huge compared to historical averages. You go back 50 years, you can plot it on, and I published this. You can plot it. It would rank in the bottom third, meaning the cheapest third of valuations going back 50 years. So I think the market can continue to rally here just based on that one thing, as long as the Fed doesn't get too aggressive at trying to taper or raise interest rates.
Awesome. Thank you, Gary.
Sure.
Thank you, Frank. So next we have VM.
Hey,
What is your question?
yeah, one more
Hi.
additional lens that I look at companies is with the rate of innovation. And one way to see that is, engineering talent. So I know Tesla has been in like the top 3 companies where, talent is joining out of after grad school. Any thoughts on talent versus market cap or growth?
What's the company? I'm sorry.
No, for Tesla, a lot of engineering grads, Tesla is number 1 company for them to join.
Oh,
And,
okay. For engineering grads. Yes. I'm sorry.
and that's one lens that many people use to see
Yeah.
the rate of innovation in a company. Is that
Yeah.
something that, Gary, you look at when you're doing projecting out?
Look, it's part of the brand. And look, Elon is so revered by the, let's call it the 20 to 40-year-old set. And, being able to get the best, it's when I look at brand, and there's so many reasons you buy a Tesla, okay? And I try to think about, range is important, performance, like 0 to 60 is important. The technology is very important. The number of charging stations is very important. But brand is really important too. And, ratings is important. But brand is important from a, when somebody wants to buy an EV, and I hate to be so simplistic about it, but I can apply this to LA, where you've got celebrities, basketball players buying Teslas, and they park them in their drive. They want everybody to see that they've got a Tesla. If you put an Audi e-tron or a Mercedes EQS or something that's not a Tesla. Tesla is the gold standard for clean energy, and I think with engineers, they want to go to Tesla because they know that, and they know that Tesla's going to go. And again, they revere Elon Musk. He's brilliant. He puts engineering first. He is very skeptical of marketing. Engineers love that, but they do have to compete with the Facebooks and the all the Silicon Valley tech giants who also they revere. Whether it be Google or Apple or Microsoft, any of them. So it's something I look at, but I kind of put it in the category of the brand, and the brand is extremely, extremely strong. It's one of the things that when I try to think like what sets Tesla apart from Ford or GM's EVs, the brand is really important. So that's how I'd answer, I guess, the question. It's qualitative.
Perfect. Thank you, VM. So next is Josh's Blonde.
Yeah, hi there.
Question?
Yeah, thanks. And thanks, Gary, for your sort of moderate, temperate sort of contribution to the community. I think it's really appreciated by all of us. Sometimes things can get a bit echo chambery, but yeah, I'm a long-term retail investor. I'm just wondering. I think we're all like preaching to the choir on 2022 estimates going up and the stock price rising. But do you ever think further out? I know it's harder to kind of forecast in the sort of 10 to 15-year range. But I'm just interested what your viewpoint would be on kind of like an end state Tesla market cap. When I look out that far, my sort of bullishness is somewhat tempered. I think maybe 10 million cars, maybe an energy business that's just as big, and maybe FSD at sort of a 25% take rate. I think maybe on the high end there's a sort of 10x left in Tesla between now and sort of 10 to 15 years. Do you ever think that far out and give a rough idea of what you think the market cap could be that far out?
Yeah. I mean, I go out to 2030, so I try to go out 10 years, and I have a model that, hits all the big variables, global SAR, EV adoption, EV share, ASP margins. And I do try to take into consideration, where could the next innovations be? I don't just blindly take Tesla's numbers and say, okay, what's that worth? Because that's usually more supply driven when, Elon says they're going to make 20 million cars. That would be 25% market share, and I don't see that happening. But I do see them getting, by 2030, I get to 10 million vehicles, so that's a 12.5% share, and that's with EV adoption globally at 50% and an EV share of 25%, I can get 10,000 vehicles. And then when I basically go out and try to figure that out, that's about $100 million of net income. And then the question is, so when you're at 50%, you're not growing anywhere near like you were. what multiple do you put on that? So I have $100 million of net income. I think at that point, you almost look a little bit like Apple. You're growing it, let's call it 10% a year, 8 to 10% a year. You could easily put a market multiple on it. And if rates are low, let's just say, 21, 22 times, you're at a $2 trillion valuation. And I know that's going to sound conservative to people, but you can't put 100 multiple on Tesla in 2030 because the math just isn't there. You're not, when EV adoption's at 50%, going to 100%, again, do the math, you're not going to get 50% volume growth. It just doesn't happen. So I would say 2 trillion would be the number I would use in 2030. And again, that's still a huge return.
Yeah, that's great. And I'm assuming that doesn't really take into account NGE as well.
No, but again, from 730 billion today to 2 trillion over, let's call it 9 years, that's a huge annual return. I wish all my stocks could do that.
Yeah, exciting if it happens.
Perfect. And we have one last question from Henry.
Hi. Thanks,
Hey.
Gary, for doing this. I think more money managers should actually do this as well. But yeah, I have a couple of questions actually. A few weeks ago, the Senate had a vote on an amendment for the limit for limiting the tax credits on EVs to 40K, and it passed. Yeah, what were your sources saying about that? Because I failed to understand what the purpose of that vote was. And also, Elon didn't like it either, right? He was posting memes around that time. That he called it, I think, sabotage, right? And yeah, so that was one question, and also the other one was on your cash flow, on the free cash flow that you shared with us. Was that for Q3 and Q4? Was that assuming a same level of capex as Q2? Okay.
Yeah. So the second question, yes, I assume the same basic level, but what's happening is the revenues are just exploding upward as volumes go up. They kind of all drop to the bottom line when you think of free cash flow. So yeah, I try to forecast all the elements of cash flow. So I look at depreciation, amortization, I look at change in working capital, I look at capex. And so this year, I don't think there's much disagreement with it. They're going to do about 5 billion in free cash flow. It's next year, it's going to be about 11. And that's, again, you got to make some assumptions about, how big the capex is going to be next year. And I think it's going to be the same as this year. Could be bigger. But that's going to be a very interesting dynamic because that's going to get all of Wall Street very focused on free cash flow. And that's why, how they reinvest it. And, some people have done some pretty good work on reinvestment of cash flow. If they just stick it into cash, that's not good. If they go out and they buy more gigafactories and they do it very aggressively, whether they go to India or UK, that's great. That's what everybody wants to see. If they go out and they buy something in a business that is not really related to EVs or autonomy or robotics, and with robotics, I could definitely see them putting more money into that, maybe even buying something. Everybody's going to love that because when you start going through your model, you have to do something with the cash. And if you put it, real simplistically, in a 1% cash, you don't get much return. If you put it in a 10 or 12% return, you can put a line item in your P&L. It really adds up very quick versus 1% return. So, yeah, 11 billion includes my estimate for capex, which is roughly the same as this year. On your first question, I think you should ignore it. That was a Republican who pushed it through as part of something else. It's not really indicative, and Congress does this all the time. It really is kabuki theater in Congress. They pushed it through. It's not anything anybody talks about in Washington. What really matters is what the House does. And the Dems in the House do in this $3.5 trillion bill. So you have to watch that. That's where the language it hasn't been written yet, but that's where the language is going to matter as to whether it's a 40,000 limit, 60,000, 80,000, or no limit. And so I would just ignore it. It's kind of noise. It was just something that some congresswoman wanted to pass, and she did it, and it was a Republican, and it's not going to be important because the Dems in the House are going to control the EV credit. So that's my view.
Yeah, I appreciate that, Gary. Thank you.
Okay.
Okay, so Gary, if you don't have anything to add, I think it's time that we wrap things up. And I would actually like to thank the audience for their patience because they were waiting like for 20
Yeah.
minutes until we were able to resolve
Yeah.
our technical
Thank you for that.
difficulties. But it says a lot if they're hanging out so long.